You often hear how the Federal Reserve growing or lowering rates impact the economy. But how exactly does each action actually impact your wallet in your day-to-day life? Well, in this video, you'll learn 5 ways the Federal Reserve impacts the life of every American when interest rates are low compared to when interest rates are high. So, without further ado, let's get into it. The first way the Federal Reserve impacts your wallet is by influencing the value of your money through how it influences inflation. In case you didn't know what inflation means, it is simply the rate at which the prices of stuffs go up in the economy over a period of time. When speaking of a period of time, people usually speak in a space of 1 year. For example, if something cost you $100 a year ago and now costs $110, the inflation rate for the year is 10%. Pretty simple. And so, if you had saved $100 last year in your bank account, but your $100 is not worth at least $110 now, your money has technically lost value, even if it is now worth as close as $109. And so, speaking of inflation, the Fed has an overall target of about 2% per year on average, meaning things costing $100 last year should cost on average $102 this year. And basically, the Fed uses interest rates to control inflation. When it raises interest rates, loans become more expensive, and so very basically, people and businesses have to use more of their money to pay their loans, which lower the amount of money they have to buy other stuffs. Since less stuffs are being bought, companies have to slow down how they raise their prices, or literally lower their prices either to attract customers or simply because their supplies surpass their demand. And so, you understand that when the Fed lowers rates, it means less money go toward paying loans, and thus more money to buy stuff, which forces companies to increase prices, which creates inflation. And thus, making the value of your money less valuable, which often makes people require their bosses to increase their wage to get more money to buy more stuffs, which in the end increases inflation even more until the Fed increases rates again. That's basically the idea. This leads us to the second way the Federal Reserve affects your wallet, which is by impacting how much you pay in interest when you take loans. Whether it is buying a car, getting a mortgage, financing school, using a credit card, or even starting a business, loans are a normal part of life nowadays. So though the Fed does not directly decide the exact interest rate on your mortgage or your car payment, it strongly influences the financial environment that banks operate in. When the Fed raises interest rates, borrowing tends to become more expensive across the economy, even if you have good credit. Mortgage rates often rise, meaning monthly housing payments get bigger. Car loans become more expensive, so financing a vehicle suddenly costs more. Credit card interest can jump higher too, which makes carrying debt even more painful and annoying. So even if your paycheck stays the same, more of your income may go toward interest payments instead of savings or spending. On the flip side, when the Fed lowers interest rates, borrowing usually becomes cheaper, especially if your credit is good. Suddenly mortgages may become more affordable, refinancing becomes attractive, businesses can take cheaper loans, and consumers feel more comfortable spending money since they have more in the bank. That is one reason low interest rate periods often feel financially easier for people trying to buy homes or finance large purchases. Of course, there is a trade-off. Easier borrowing can sometimes help fuel inflation if too much money starts flowing too quickly. The third way the Federal Reserve impacts your wallet is through something people do not always connect to interest rates right away: the job market. Whether jobs are easy to find, whether companies are hiring aggressively, and even how confident people feel about switching careers can all be influenced by the Fed. And again, it mostly comes back to interest rates. When money is cheaper to borrow, businesses are usually more willing to expand. They may open new locations, invest in new projects, hire more workers, or take bigger risks because financing costs are lower. I'll give you an example. If interest rates are low and a company saves $100,000 on mortgage payments per year, they can now afford to pay 2 more marketing agents $50,000 each to promote their products and then make even more money. With the extra money the company is now making, they can either employ a third marketing agent or even raise the salary of the 2 agents they just employed and make it $60,000 a year for each. Do you get the idea? With lower interest rates, it is a better environment for businesses, which makes it better for employees, and it is also a better environment for consumers since they have more money in the bank, which makes it easier for businesses to grow as well. When interest rates are high, the inverse occurs. It is hard for consumers, employees, and businesses, but inflation tends to remain lower because of it, which can calm things down for some time. The fourth way the Federal Reserve impacts your wallet is through the growth of your assets, meaning things like stocks, retirement accounts, and even real estate. Even if you never actively invest, chances are you are affected more than you think. If you have a 401k, a retirement fund, or even own a home, Federal Reserve decisions can quietly shape how much those things grow over time. When interest rates are low, money becomes cheaper to borrow, and that often pushes investors toward assets like stocks and real estate. Businesses can borrow more cheaply to expand, investors feel more optimistic, and home buyers suddenly qualify for larger mortgages because monthly payments become more manageable. That is one reason periods of low rates are often associated with rising stock markets and rapidly growing home prices. Cheap money tends to flow into investments, pushing values higher for every asset owner. But when the Fed raises rates, the opposite can happen. Higher borrowing costs can slow business growth, cool real estate demand, and make safer investments like bonds more attractive compared to stocks. That does not mean markets automatically crash every time rates go up, but higher rate environments often make investing feel bumpier and simply harder, because once again, people have less money in their pockets in the first place. The fifth way the Federal Reserve impacts your wallet is through your savings account. When the Fed raises interest rates, banks often start paying more interest on savings accounts, money market accounts, and certificates of deposit, also known as CDs. Why? Because banks compete for deposits, and when rates rise across the economy, they usually need to offer better returns to attract customers. That means people holding cash can sometimes earn much more money simply by leaving savings in the bank compared to a low interest rate environment. But when the Fed lowers interest rates, savings accounts usually become less rewarding. Banks earn less on lending and investments, so the interest they pay customers often falls as well. And so, in a way, what is good for borrowers is not always good for savers. Low rates often help people taking loans, but they can hurt people trying to earn interest on savings. Higher rates can benefit savers, but make borrowing more painful. And once again, this shows how deeply the Federal Reserve shapes everything financially. These points are not the only things the Fed impact, but we'll keep the rest for another video. That said, if you're serious about your finances and you want tools for budgeting, in the video description you'll find budgeting books to track your finances that you can order on Amazon. If you end up buying one, it would directly support the channel as well. In any case, if you enjoyed this video and want more simple explanations about similar or other financial topic, give it a like and click on one of the videos showing at your screen right now. I'll see you on the next one.